Hi, it's Professor Barati. I wanted to go over the quiz problem that people seem to be having some difficulty. Now, you're all on algorithmic questions, so your numbers might be different, but the approach will be the same for this problem. So this is the problem here of a mug producer whose business began operations on January 1st, and for the 12 months following, the variable costs based on mugs produced. They give you the following: direct materials, direct manufacturing labor, indirect manufacturing costs, which is manufacturing overhead, administration and marketing, variable costs, fixed costs are administration and marketing, and indirect manufacturing costs, which is manufacturing overhead. So the problem is the same for everyone. The numbers might have changed. So I'm going to go right through the answers quickly. And essentially I wrote it out this way here. Basically the problem here said, one, give us the compute the direct materials inventory costs ending the December 31st for year one. So that's our ending balance. So basically on January 1st, the company started, so it had no beginning direct material inventory. They basically told us that 18,000 mugs were produced and 0.4 pounds of materials are used to produce one mug. Therefore, 18,000 mugs times 0.4 gave us 7,200 pounds of material costs used. That would be on the credit side, because that means that you're crediting materials for direct materials used. The debit side is WIP. It went into production. The material cost they give us right in the problem is $2,700. So you divide that by the 7,200 pounds, which I calculated here, gives you a cost per pound of 0.375. They told us that the inventory consisted of 2,700 pounds. So simply take the 2,700 pounds at 0.375, and your ending inventory for direct materials is 1,012, which is right here. Then it says compute the finished goods ending inventory in units at the end of the year. So again, beginning inventory was 0. The cost of goods manufactured, not sold, they basically did 18,000 mugs for the year, which is given to you in the problem. But we need to figure out what the ending inventory is. So they tell us that the dollar amount is $2,005, $2,050 in dollars. If we divide that by the cost per mug produced, that we'll be able to figure out the ending inventory. So how did I get to $2,005? Direct materials, direct labor, indirect manufacturing, and indirect manufacturing again is 36,900. Divide that by the 18,000 mugs that we made is an average cost per mug of $2,005. That's your inventory cost. I did not use the marketing and administrative costs to figure out my production or my manufacturing costs, because that's not GAAP, unless they tell you to use a contribution margin, but they didn't ask us that. So we have to use the traditional GAAP absorption costing format, which is manufacturing costs only. Notice I put absorption in parentheses. So if you take the 2,050 divided by the average cost per mug of 2,005 cents, you get $1,000. Now, how do we get to our operating income? They give us a revenue in the problem for $66,300. We need to calculate our cost of goods sold. We do that by taking the 18,000 mugs that were produced. That's a debit to finished goods, because that's your cost of goods manufactured. We know our ending in units. They asked us to calculate that. So 18,000 minus 17,000 gets us to $1,000 ending inventory balance. This is just simply inventory accounting. The cost of goods sold is 17,000 units. And we know that the cost per mug is $2.05. Therefore, 17,000 at $2.05 gives us a cost of goods sold of $34,850. Gross profit then is $31,450. I simply take the marketing and selling expenses, I added them together to get an operating profit of $17,170 using the absorption method. Essentially, those are the A through D answers for you. I hope this helps you, and thanks for watching.